Hello everyone, this is the fourth and last of the series about how to invest like Warren Buffett, where we try to find out what to look for when you want to invest in a company, and we try to understand those complicated financial statements that usually look like a mountain of numbers with little meaning. My name is Rick, and in today's video we're focusing on probably one of the most important financial statements of all, which is the cash flow statement. If you like this kind of contents, you can subscribe to my channel, and in future videos I'm gonna try to share everything that I learned, because sharing is caring, right? But now let's get back on track and let's focus on the most important financial statement. The cash flow statement is probably the most important financial statement because it allows investors to calculate the most important value of a company, which is the free cash flow. The free cash flow is the cash left to a company after the company pays the operating expenses, which are the expenses for the operation of the business, and the capital expenditures, which are the investments for plant, equipment, and all other assets. So basically, it's the cash that remains available for a company after paying for all the expenses. Now, the free cash flow is not simply found in a cash flow statement. You have to calculate it. It might be a little tricky, but simply put, the free cash flow is calculated by taking the operating cash flow of a company, which is the cash that the company generated with its business operations, and subtracting the capital expenditures. We will see later how to calculate the free cash flow, but for now just remember that it's much easier to just find it in a website like morningstar.com. Generally speaking, investors love companies that generate a lot of free cash flow because the free cash flow indicates the ability of the company to pay debts, pay out dividends, buy back stocks, and most of all, to make the company grow. Many investors like Warren Buffett or Bill Ackman prefer using free cash flow than net income to calculate the financial performance of a company because the free cash flow is much harder to manipulate. What they do is they use the free cash flow to calculate the intrinsic value of a company, which is the real value of a company from the investor's perspective, taking into account the future growth that the investor is expecting to see for the company. The intrinsic value of the company that investors calculate from the free cash flow is different from the stock price of the company in the stock market. And this allows you to make a comparison and understand if the company is undervalued or overvalued at the moment. Now, you might ask, how do I calculate the intrinsic value of a company? There is a process that is called the discounted cash flow analysis, and in order to explain this process, I will need a video alone for it. But if you want, I have a Google Sheets file where I calculate it, and if you want, just write me down in the comment section below your interest, and I can make a video where I explain how I created this table and how I use it. Now let's move on to other parameters that, unlike the free cash flow, can be directly found in the cash flow statement, and still they play a really important role in the financial analysis of a company. Oh, and by the way, if you haven't already, don't forget to subscribe to my channel and watch the other videos of this series so that you can get a whole overview on how to read and interpret financial statements Buffett style. If you've seen the last few videos, you might have noticed that the income statement and the balance sheet don't really give any information about how much money actually flows within the company. Since most companies use an accrual method of accounting as opposed to the cash method, therefore the sales are booked when the goods walk out the door and not when the money gets in, then it has become necessary to keep separate track of the actual cash that flows in and out of the company. And the cash flow statement was created exactly for this purpose. This time, in order to see how the cash flow statement works and what are the important items, let's use morningstar.com. So you just need to go to morningstar.com and type KO, which is the ticker of Coca-Cola, in the bar in the top left. You will land on a page that contains a lot of information about the company, like general data of the company or the stock, as well as detailed financial information and articles written by Morningstar analysts. But now let's focus on the cash flow statement. Therefore, let's click on Key Ratios and then on Full Key Ratios data. Chrome will open another tab that shows right away all the important financial data of Coca-Cola. Now, most of this data comes from the income statements, like revenue, net income, and so on, as well as from the cash flow statements like operating cash flow, cap spending, and free cash flow. But now we want to focus solely on the cash flow statements. Therefore, let's click on Financials and then let's choose Cash Flow. Now, first thing I'd like you to notice is that the cash flow statements are divided in three sections: cash flow from operating activities, cash flow from investing activities, and cash flow from financial activities. Now, let's describe them for a moment one by one. Cash flow from operating activities, as the name suggests, contains all the cash flows in and out that are generated from operations. The first item is something that you should know very well if you've watched my video about the income statement, and it's the net income or net earnings. This is exactly the value that you find in the income statement, and the cash flow statement starts from this value. So the company has received a total of $9.8 billion in net income in 2021. But that doesn't mean that at the end of the year, they had $9.8 billion in cash, because there have been other cash flows due to operations, and this is all reported here in these items. So you start from the net income, and then you have depreciation and amortization of plant and equipment, and then all other operating gains or charges. The sum of all these cash inflows and outflows gives the net cash provided by operating activities, which was $12,625 for Coca-Cola in 2021. Remember this value because we're going to use it to calculate the free cash flow later. Now let's go to cash flow from investing activities. Here you find all cash outflows due to investments that the company did. So summing up all the cash flows from investing activities, you get the total cash flow from investing operation, or net cash used for investing activities. The last one is the cash flow from financing activities. It includes all inflows and outflows of cash related to financial activities, like the payment of dividends, as well as cash from selling or buying company stocks or selling or buying bonds. Summing all these items, you get a total cash flow from financing activities. Summing together these 3 points, we get the company's net change in cash, which for Coca-Cola in 2021 was this $2,115 or $2.9 billion. Let's go now a little bit more in detail through these 3 components of the cash flow statements. Let's start with the cash flow from operating activities. Now, apart from the net income that we already discussed in a video about the income statement, the first item you see here is depreciation and amortization. The cost of business assets, for example, the machines that Coca-Cola uses to bottle the cola or to mix ingredients, or the trucks that they use to distribute the cola bottles all over the country, are expensed every year during the lifetime of the asset in the income statement. That's why we need in the cash flow statement this item called depreciation and amortization to even out. Now, to make it clear, let's say that Coca-Cola buys a truck for $400,000. And this truck has a taxable lifespan of 10 years. That means that Coca-Cola will report a cost of $40,000 every year for the next 10 years in the income statement. So be careful, I said income statement, not cash flow statement. So follow me now. Since we start the cash flow statement with the net income value that was calculated in the income statement, deducting the depreciation and amortization that didn't actually take place as a cash flow, now in the cash flow statement, the depreciation and amortization is added back to the net income as a positive value. Now, after depreciation and amortization, another item which is worth mentioning is inventory. Now in the cash flow statement, you just see the inventory that was sold or bought within that year in comparison to the year before. Besides inventory, other items that are worth mentioning are accounts receivable, which is money owed to the company that flowed that year into the company. Accounts payable, which on the contrary was money owed by the company, which flowed out of the company that year, and prepaid expenses, which are upfront payments for an expense such as an annual insurance payment that a company has not yet incurred. Now let's move to cash flow from investing activities. Here we find right away an item which is incredibly important and which is used to calculate the free cash flow. This is that so-called capital expenditure, or CapEx, which here is noted as investments in property, plant and equipment. Capital expenditures are money spent by a business on acquiring or maintaining fixed assets, such as lands, buildings or equipment, which are expensed over a period of time greater than a year through depreciation and amortization. Buying a new truck for Coca-Cola, for example, is a capital expenditure, which is expensed through depreciation over its life cycle. Now, to make it short, not having capital expenditures or keeping them low is one of the secrets to getting rich for a company. This is the reason why Buffett never invested in telephone companies which have a really high value of capital expenditures. Let's make now some examples using average values over the 10 years between 1997 and 2007. Coca-Cola earnings $20.21 per share, capital expenditures $4.01 per share, 19% of total earnings. Moody's $14.24 per share, capital expenditures 84 cents per share, 5% of total earnings. General Motors earnings $31.64 per share, capital expenditure $140.42 per share, namely 444% of the total earnings. And Goodyear earnings $3.67 per share and capital expenditure $34.88 per share, namely 950% of the total earnings. Now you might ask, if General Motors and Goodyear respectively spent 444% and 950% of their net income in capital expenditures, where did all the extra money come from? Well, it came from bank loans and from selling a lot of new debt to the public. Such actions increase debt, which increases spend on interest payments, which is never a good thing. Historically, companies with a durable competitive advantage use a small percentage of their net earnings in capital expenditures. It should be under 50% to show that the company might have a durable competitive advantage, but if you find something around 25 to 30% and it's constantly like that over the years, then you most likely found a company with a durable competitive advantage. Now, we don't need to go over every item of the cash flow from investing operation because the capital expenditures is the most important. But right now I can already show you how Morningstar calculates the free cash flow, because they do it based on the operating cash flow, which is the result of the first section here. And for Coca-Cola in 2001 was 12,625, and the capital expenditure, which in 2001 was 1,367. So if you subtract 1,367 from 12,625, you obtain 11,258 or $11 billion. So this was the free cash flow of Coca-Cola generated in 2021. So now let's move on to the cash flow from financing activities. So now the company has had a net income, has paid the capital expenditures, and it's given the possibility to use the remaining cash flow, which is the free cash flow. Some of this free cash flow was used for investments in the growth of the company, and this can be seen in the section 2 of the investing activities. But part of it is used then to pay dividends or to buy back stocks. Now, Coca-Cola didn't buy so many shares back in 2020 and 2021. But if you look at the years before, you'll see that usually they buy back their stock much more than they issue new stock or sell their stock. This is something that Buffett likes in a company, when the company uses excess cash to buy back their own stocks instead of paying out dividends. So after I gave you this overview of the cash flow statement, and also if you watch the other two videos of mine where I explain the income statement and the balance sheet, now you have an overview and you can understand which numbers and parameters are the most important to look for when deciding to invest in a company. Companies with a durable competitive advantage usually never sell at a bargain price. So when do you buy into it? There are basically two moments in which you should be active in stock picking and you can potentially find great deals. Number one, in bear markets. This is by far the best way for private investors like us to invest in good companies with a cheap price. Number two, when the company does something stupid but repairable that drives its stock price down. An example is when Samsung a couple of years ago produced a tablet that started exploding in airplanes. I don't know if you remember about that. Of course, there was an accident that started to happen a couple of times and that drove the price of Samsung down. Okay, and when do you stay away from these businesses instead? You do that at the highs of bull markets. For example, 2021 was the peak of a long bull market that probably started in 2010 with some ups and downs. So I guess that whoever started investing in 2021 is down by a lot right now. Theoretically, you should never sell as long as a company maintains its durable competitive advantage. Still, there are times in which it might be a good option to sell. Number one, when you need money to invest in an even better company with an even better price, which occasionally happens. Number two, when the company looks like it's losing its durable competitive advantage. Think, for example, of companies like television companies or newspapers when internet came along. And number three, during bull markets, when the stock market goes crazy and the prices go through the ceiling. And of course, in this case, you shouldn't sell a great company to buy another company with a high price to earning ratio. Instead, you should wait, maybe invest in some US treasuries and wait for the next bear market. Okay, that was all. I hope you could find some value in this video. If you did, I'd appreciate if you subscribe to my channel and hit the like button. In my channel, I try to talk about what I learned in the topics of finance, self-development, and productivity. So if you like these topics, I'd love to have you on the journey with me. Oh, and if you haven't, check out also my other videos about financial statements and the durable competitive advantage. I will link them in the description below. Well, I wish you a great evening and I hope to see you in the next video. Ciao!